Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Hello, everyone, and welcome to the Top 5 at 5. I'm Catherine Murray, I think, as you know, and we've got Joel Kulina on with us today. He is the head of tech and media trading over at Wedbush Securities, which is a U.S. investment firm. Joel, so great to have you. Thank you for taking the time. And I know, look, we can see all the screens in your background. It's not only are you always busy as a trader, but you're really busy. Talk to us a little bit about what you see going on in the markets. From what I understand, the volumes are up pretty significantly. It might be surprising to some, but this is 6 out of 7 days in a row higher for, I think, the S&P.
Yeah, it's been a welcome. That's been the weird part of 2022. There's obviously we've seen a lot of outsized, outsized volatility in terms of major swings in the indices and stocks under the hood for various reasons. The VIX is kind of going all over the place with obviously with the Russian-Ukraine situation kind of ticking off the last, kind of big kind of catalyst. But pockets of this year, it's been volume's been very well below average, really up until recently. And that's kind of been another poor liquidity, buy sides, terrible liquidity. That's been the number one source of frustration for a lot of investors all year. And guys obviously came into this year, at least the tech dedicated, long short hedge fund managers positioned wrong. People thought, the high flying growth, especially the software names would see a little bit mean reversion to start the calendar year. And if you look back, remember the first week of January, tech got absolutely killed. I mean, there was a long list of names down 10 to 15% just in that first week of January alone. And it's really, I preface that only because this year has really it's been about fund managers managing their positions more than anything versus looking for new ideas. And guys have been really just playing behind the 8 ball from pretty much day one. I think it was January 3rd was that first Monday. And that's and then again with the inconsistency of liquidity and volumes on any given day, that's just kind of been another layer of frustration for the investment world.
Yeah. Well, and I think too, when you talk about just managing your positions versus essentially looking for new names, I think a lot of our viewers who have portfolios of their own are saying, well, what does that even mean? How do you even do it? And especially since I think we know that a lot of the hedge fund players and tech players have been, severely underperforming the broader market. So, are they even doing it well? What do we even need to talk about as it relates to managing your own risk portfolio?
It really depends on the fund and what kind of strategy they're running. So the multi-strat, the larger, kind of hedge fund managers, they've had the affordability to kind of, they can, maybe their long short strategy is not performing well, but maybe the macro book is doing well. So they're doing well, but it's been more the dedicated, the growth momentum strategy type of guys that are obviously look like, nothing could go wrong for the most part of the better part of the past 5 years, especially since we kind of, we saw peak COVID in 2020, every dip was bought consistently. Well, that those have been where guys have struggling the most. And what I'm hearing about, obviously I don't have firsthand knowledge of it, but something for you to keep an eye on as well, is really kind of what transpires in the private market as 2020 goes along. Because again, name like Databricks, has been one of the most highly anticipated, companies still in the private world. I think their last valuation was last summer around $38 billion. Well, where is that right now? 20 billion, 15 billion, 20. It really, that's where you can see the pain start to even amplify is in the private side of things, where valuations were just getting, again, way ahead of themselves. And I think, we woke up this week, we had a deal, an M&A deal in the software space. Private equity firm Thoma Bravo bought Anaplan, I think about 13 times sales, $66 a share. Why that's very interesting to me is because Anaplan's peak COVID price was around $86. So what is that telling you? That management within 12 months is willing to take an offer 23% below peak share price at a much lower valuation. It's clearly they've came to the realization that's as good as it's going to get. And that's, you really still want to be cautious in the higher flying pockets of the market. We're going to see short squeezes. We're seeing it right now in the Cathie Wood universe. But I think guys can be very cautious about going, head first, especially as I think we've already seen, half of the world's central banks have already cut rates recently, and we know we're in a tightening cycle. So I don't see how that's going to remain a very choppy, difficult trade to navigate, at least for the near term.
Wait, let me just clarify. Half of the world central bankers have cut rates or raised rates?
Raised rates. Sorry, other than China. So the irony is, other than China, who's they didn't cut their lending rate on Sunday evening, which bulls were hoping for. But every other central bank's pretty much in the tightening mode. So again, that's the limit. Evaluations to a certain degree, and I think it's going to be very rare where we look at within tech and see a long list of companies trading north of 25 times sales. I think just back in November, there was like 30 to 40 of them. And I think right about now, there's maybe mid-single digits at best.
So then that can also lend itself as to why we're actually seeing a rally today, and why there might be just also some real buying. You would know better than me because you're sitting on the institutional trading desk. Real buying versus just a short squeeze. In other words, we've already had enough of a drawdown. People know that we're in a rate tightening mode. There is maybe some confidence that Fed Chair Jerome Powell will walk that line well. The statement last week was taken away as hawkish, but he also continues to say, look, we're going to be nimble. We don't have to raise rates at every meeting. To me, I don't want to say that's dovish, but it's at least recognizing that we're going to do what it takes when we think we need to do it. And we're able to do it because of the Ukraine-Russia war. So in other words, is the worst behind us? We've seen a drawdown and almost at historical levels when we've seen previous wars going back 60 years.
Yeah, I think what I'm most concerned about. Well, actually, let's talk back about flows. Where's money going? So, yeah, I mean, I think Bank of America had their monthly fund manager survey out. I want to believe last week it came out, and what really jumps out, cash balances were the highest they've been since peak COVID, March 2020, at 5.9%. And lo and behold, there was a 3 or 4 day stretch, last week, where my flows on my desk were, we're obviously a smaller player here at Wedbush, but it's usually similar across the street, over 2 to 1 better to buy. You're seeing real money going back to work, but it's not just kind of like we saw maybe during 2020 or even prior, where everyone just kind of jumped headfirst into tech. Guys are being a lot more selective. There's been a large cap tilt to that. So whether it's been in Microsoft, Alphabet, Apple, names that have great business models, obviously defensible moats have been built around them, and by balance sheets that are just kind of the best on planet Earth. And that's kind of where you're seeing the flight to quality. It's never been more true in this kind of difficult market. And I look at Applied Materials as a semi-equipment name, ASML. They're pretty much the only company on the earth that can produces these really leading edge tools to make the most complex chips that are out there. So there's definitely that tilt, guys going towards large cap, and again, not going for the hyper growth names like the Cathie Wood type of stocks. Just be a lot more selective with those names, whereas money's going back to work in higher quality names out there.
Just describe Cathie Wood and Cathie Wood's names for anybody who doesn't know.
Yeah, so she obviously came to fame. I guess not. She was pretty much known as kind of a rogue, kind of renegade. I think in the 2010s when she was, I think, at AllianceBernstein, and then she was kind of like a very outspoken bull on disruptive tech, and she was very early on EV, namely Tesla. She was big in names like Zoom early on, DocuSign, and the media played along with it. If you rewind 12 months, maybe 15 months, she was she got to a cult status. On CNBC, she would get a lot of attention in Barron's or whatever it may be. And if you look back at inflows of her ETF, products, they peaked Q1 of last year. And that's usually what happens, right? And then I think since then have fallen 50 to 60%, maybe a little bit more off her highs. And where I struggle with her is, I think there's really, she'll be a case study to some degree in business schools at some point, at least from an investment talking point of view, because there's clearly a risk. There was no really risk process in place. Like, I get it. If you like Zoom 2 years ago and you were early to story, or even if you bought it on that first 30 to 40% move and you still thought you had remote learning as a tailwind. Businesses, still small and medium-sized businesses, were still getting up to getting up to speed on working remotely. But again, when everything started to reverse and the world returned to normal, she just continued to double down and average down on these bets, and that never works. Yeah, maybe every now and then, but again, when you have companies that benefited from a once in a century event, and it led to this really funky kind of valuation, gap that kind of we saw not that long ago, and even to the day, she bought Twitter, a couple quarters ago on a blow up, and then she sold it lower. She bought DocuSign when they blew up back in November. I think the stock was trading around 145. Then she sold it at 110. Like, just didn't, again, no really thought process, no risk management. And that's kind of what always was a little baffling to me. At some point, how do you keep on, how are you holding these stocks when the world's telling you something else is going on and the price action is telling you something going on? And
that's a good point to pick up on as well. To pay attention to the price action, versus what you want to happen or what you think sometimes are the fundamentals. The fundamentals might always be the fundamentals, but you have to also pay attention to the price action in terms of where you want to step in and where you want to sell. But Joel, looking forward then, given, and I think your take is going to be that there are just so many uncertainties, maybe describe how you view those uncertainties, but perhaps more importantly, what themes do you want to play right now? What stocks do you want to play?
Yeah, I mean, within tech, I mean, I work with a guy named Dan Ives. He's a media legend as well, so I got to give him credit. He's worth listening to, and I mean, he's been very vocal on cybersecurity, and I think where I know Congress, they passed some new legislation earlier this month as well, and I think it's really going to force companies that always underinvested in security. Now they have to. That's going to be put in law, where these companies have to implement and spend higher percentage of their revenues on security. In the past, it was always a good talking point. It sounded good on a conference call. Zuckerberg was notorious for it. Yeah, we're going to spend so much money on security. Then lo and behold, they never really increased their budget as the revenues kept on ballooning. So it just kind of stayed, ended up becoming a smaller portion of their revs. But security, I mean, I think there was massive growth prior to this Russian-Ukraine, escalation, and I think it's a harsh reality of the world we live in. Cyber warfare is one of the most advantageous tools a country can use versus some of its enemies, and I just don't see this going away. So I look at names like Palo Alto as a large cap name. Their recent numbers were fantastic, and then moving down to like identity names like SailPoint, Qualys. Again, and they're not crazy expensive as well. So again, you're staying away from that Cathie Wood hyper growth, super expensive software kind of, sphere, and sticking to names that are a little bit more reasonably valued as well to some degree, but just the fundamentals remain rock solid.
And so, Joel, just to be really clear here as well, because yes, for years, and I've interviewed so many CEOs of cybersecurity companies, we talked to analysts talking about cybersecurity stocks,
yep.
And where the budgets were always going to grow. So the nuance or the change here is what is going on in Congress.
Yep.
Can you just describe that a little bit more in terms of the timing and whether or not this is something that will get passed? It has not been passed, correct?
It's a bipartisan issue. So, I mean, I think there's people, everyone, guys on both sides of the aisle are very adamant in pushing and getting the bill through. And from everything I've heard, the checks from DC, at least from our guys, that it's going to get passed. And I think, again, the Russian-Ukraine situation has kind of elevated to this something that it needs to be done. There's another semi, I want to call it a high-profile attack overnight, but funny enough, a cybersecurity company, Okta, they're the victim of an attack, and they're one of the leaders out there in identity security management. So it just shows that it's increasingly becoming sophisticated, and governments have to invest in it. And like a lot of governments have realized, because of the supply chain mess, we need to start investing more in semiconductor manufacturing. The same resources are going to be put towards security. So I don't think there's an actual time frame. It's probably, again, that's more of a longer theme. As kind of as things evolve, we know it won't happen overnight in terms of companies, spending, but we know it's what keeps CIOs up at night.
And so it would require companies to spend a certain percentage of the revenue, or
I don't think that those details haven't been kind of hammered out. But again, it's going to, what I read, I think from a couple of competitors' notes is, it's going to force companies that have underspent on security.
Yeah.
It'll pretty much just force them that they have to make, spend, I don't know if it's a percentage or whatever that number may be. I don't think that's been decided yet, but it's not going away. And I think, let's hope that China doesn't escalate the situation in Taiwan. I don't think they will after seeing what's happened to Russia, given all the sanctions and the economic fallout from that. That'd be a mighty big gamble for China to make. And what would happen there? Just given, obviously, if the US companies pull out of China, I mean, imagine the amount of jobs that would be lost overnight. If a company like Apple's, if US placed sanctions and they had to leave China, it'd be potentially hundreds of thousands of jobs. The ripple effect would be catastrophic.
That's a great point. And also, I believe that US, UK, and Europe accounts for 30% of China's exports.
Yeah. So I'm more hopeful that we won't see that situation kind of go to the next level. And then I think where Powell's going to, and what makes it difficult to get overly bullish on tech, I think clearly we've seen technicals have played a big part in this recent bounce. I think the Nasdaq's now 12% off the lows in just over a week. And we know sentiment was very gloomy, deeply sold prices. And here we go. A couple, catalysts that have come, the Fed was viewed as a clearing event. Let's just go do it. Sorry about that. And it's kind of led to this type of move that we're seeing. And again, it hasn't just been short covering; it's been obviously real money being put to work as well. But again, I think the upside is going to be somewhat limited because of, I'm more fearful of inflationary pressures. Obviously everyone's talking about wheat, the price of oil, food and fertilizer are going parabolic, and I think that's what kind of worries me. Listening to some like an interesting podcast and some smart people, how farmers are going to have to cut back on how much acres they can plant just because they can't afford the fertilizer.
Right.
How does that impact? May not impact us here in North America to some degree, but how does it impact Middle East or Africa or different parts of Europe? And we know when I think the Arab Spring, the wheat crisis was one of the kind of part of the factors that led to the Arab Spring not that long ago. People can't get food. It leads to kind of unfortunately pretty catastrophic things. So I don't want to sound too gloom and doom.
Yeah.
But that's why I think it's going to be very difficult for Powell to kind of do a 180 in terms of his policy, like we saw in early 2019, after some of his more hawkish policy measures that he did in Q4 of the prior year. So that's kind of what I'm looking at. Even if the situation, the ceasefire, war was to end today, it still feels like there's going to be some lingering supply chain headaches. Even Volvo today, who had been very constructive on improving supply chain, they just said a couple hours ago, supply chain semi shortages have gotten worse over the past couple of weeks. So the bottlenecks aren't really improving. And I think what we saw last quarter, especially in technology, it impacted not only margins, but also top line. And so does some of this stuff start impacting, further impact demand destruction from a consumer point of view as well?
Yeah, it seems as though that certain areas, those certain pockets and very small pockets, and the choice in terms of looking at stocks or the opportunity set is getting smaller and smaller. But in the cybersecurity space, that's one area where you're actually starting to be able to see some price increases. And, we might see companies, whether it's consumer staples or what have you, be able to increase their prices, but then of course their input costs are increasing as well. And you can liken that to the farmers as well. They might be able to afford, but they can't afford the input costs of the fertilizer or what have you. So it's a bit of a vicious circle. Back to your point about Fed Chair Jerome Powell, when we went back to, I guess, my goodness, these years have flown by, but if it was 2018, when he became a little bit more hawkish, he was able to reverse it then. The difference though now, Joel, is potentially that, and there's no change between then when it was President Trump or President Biden, but it can become a bit of a political issue. And, with the midterm elections coming up, no president wants to see sky high inflation. And the view, of course, is if you raise rates, you can combat inflation by decreasing the demand up there. But people seem to forget that that governments around the world have just put trillions of dollars in consumers' pockets. It's not that people earn this money, it was just given. And so that's why we're able to see so many people purchase things that maybe they wouldn't have otherwise purchased, And
Yep.
that's also part of the inflation equation. It's not just oil.
Yeah, exactly. And I look at Roku. And Roku's obviously a poster child for a work from home, pandemic winner. And I thought their CEO, who's a very smart guy, he said it best on the last earnings call. He came out and said it straight up. He said, he was very honest. He said, we over-earned in 2021. COVID led to demand accelerating. Most companies, because of the shock of the situation, reduced spending almost immediately, cut back their workforce. And then you had obviously multiples went parabolic because of all the stimulus that was thrown at the global economies. All three of those forces are in complete reverse. So that's why the next earnings season is going to be very, very interesting. And I think obviously, as I mentioned earlier, how especially guys I talk to in the TMT kind of tech kind of universe have been playing defense from day one of this calendar year. Is it? And I think that's kind of it's what we've seen that this year also saw the biggest gap in growth versus value performance since 1995, and it has been narrowing. We've seen some mean reversion there, obviously the past week as well. But I think you're seeing for the first time in a long time, there's other sectors that are a lot more attractive to guys running money than just having to pile all their money in tech and being fearful of underperforming the bench. And I think could limit the upside to tech, at least in the near term. Again, let's hope in 6 months things are a little bit more clear, a lot less uncertainty regarding inflationary pressures and things like that. And then, but again, it seems like at least in the near term, things are going to be very just kind of a back and forth chop, to say the least.
Got it. Okay, so you gave us 3 ideas within the cybersecurity space: SailPoint, Qualysys, and Palo Alto Network.
Yep.
You talked about AMAT, right? Liking AMAT.
So I mentioned AMAT actually. So ASML is probably my top semiconductor pick. Like I said earlier, they are the only company in the world that produces these tools that can actually manufacture, leading edge chips. So that's 3 nanometer, which is not yet really in production, but 4 nanometer, 5 nanometer, 7 nanometer, which again is what all of our phones are all of our devices are powered on, pretty much. So that's for artificial intelligence as well. Obviously, for GPUs, just really, again, high performance computing. They are literally the only company that can provide these tools. So, their biggest risk then is obviously something were to happen to China and they can no longer ship to their Chinese clients. But again, they built a defensible moat. No one can do what they do. And again, it's a rock solid sheet as well. And then again, going down the chain, name like Applied Materials, they benefit from, obviously, you're not seeing chip makers slow their spending because there's still an arms race to dominate AI, 5G, and high performance computing. And then, as I mentioned earlier in the show as well, we know that both the US and Europe are finally, for the first time in what probably a long time, are really realizing, because of all the supply disruptions, why are all the world's, pretty much the bulk of the world's fab facilities based in Taiwan? How can we put these in add more in Europe and add more manufacturing capabilities in the United States as well? So you have to equip these plants. Now that could be a decade-long type of phase. So again, once it's in motion, it's going to be a tailwind, continued tailwind
for some of these companies within the chip sector, semiconductor. So, but Joel, okay, last thing here, we'll wrap it. But what about Nvidia?
Yeah, so they're having their analyst meeting right now. And again, another name, we actually downgraded the stock last November, and I'll give my analyst credit. He downgraded simply on valuation, obviously downgrading one of the at the time, remember November, we were still in the midst of a secular bull market and tech could do no wrong. And eventually he just took a step back and said, this valuation's got a little bit crazy. And it had. The stock was up, I think it had 100% rally at one point from its September lows to its November peak. Just really didn't, in the story, it wasn't like a well-known under the radar story, but retail was really involved with it with kind of short dated call option activity. But yeah, they're having an analyst meeting right now. They're introducing some new CPU architecture. There's a focus on the new GPUs. It's still one of the best companies on planet Earth. So again, if you're comfortable with the valuation, that's the biggest risk is valuation. But in terms of management team, what they're doing in terms of benefiting from continued demand from the gaming vertical, data center, Again, it's still a great company. I actually prefer AMD. I think it's cheaper. And again, still, I think Lisa Su is probably the best CEO at the moment in tech, if not at least the semiconductor space. For what she's able to do and turn that company around. And I think the AMD story is a little bit simpler, because it's not, again, valuation is not as crazy, and it's still just a simple market share gain story. And I see them continue to benefit for at least the next 2 to 3 years as Intel's trying to close that technology gap. But it still seems like it's years away from being relevant again.
Yeah. AMD over Intel.
Oh, all day. Yep.
Yeah. Okay. All right, Joel, we'll leave it there. Great to see you. Thank you so much.
Thanks for having me.
Yes. We'll speak soon. Thanks.
Take care.
Bye.